A lot of individuals in the U.S. home market are unaware of the new housing trends, but you may be surprised to hear this. We've recently seen the launch of 5% down payment loans, but now we're going to see 1% down payment loans. How will these new loan programs play out? We will inevitably see a significant number of mortgage brokers, house flippers, and real estate agents exiting their industries shortly. As interest changes continue to rise, we anticipate that there will be a domino effect for many businesses. Unfortunately, this could cause many business closures and layoffs in the second half of 2024. Throughout the U.S. record, despite favorable interest rates of 3% in 2020 and 2021, buyers were still caught up with debt-to-income ratios hovering around 35 to 36%. You're probably wondering what this ratio indicates. Simply put, it refers to the basic metrics you need to meet before diving into home ownership. It takes into account the mortgage rates related to the purchase of the house and divides this amount according to your gross income. This phenomenon can result in a higher probability of default and foreclosure, especially for those consumers who put down a small amount when purchasing their dream homes in 2024. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. The loan market has also been experiencing some turbulence recently, but the state of affairs is not so bad because it was worse during the last economic crisis in 2008. One important difference is that this time, lenders are more cautious. They check people's earnings and make sure they're able to come up with the money for the loans they use. Another amazing improvement is that most loans now issued have a fixed fee instead of an adjustable one. This is huge because adjustable rate loans were one of the big factors that led to the foreclosure crisis and rocked the housing market the last time in 2008. With fixed fee loans, homeowners have the peace of mind that their mortgage payments won't fluctuate, reducing the chance of loan defaults. Now that we have stated all this, it would be naive to assume that there can be no exception. There's always a chance that some people may also default on their loans, and this can lead to an increase in foreclosures. It's hard to predict how many foreclosures we might see, but it's safe to say that even 1 million could be disastrous for the housing market. One reason is that the housing stock in California is extremely low. Even a small increase in foreclosures could start a downward spiral in home prices. This, in turn, may lead to more foreclosures, and the cycle may continue. Lots of people rush into home ownership without thinking carefully about whether they can honestly afford it. Unfortunately, this can cause a spike in loan defaults and foreclosures sooner than we would expect. According to Fannie Mae statistics, the average debt-to-income ratio for home buyers is now persistently excessive, surpassing levels reached during the infamous housing bubble in 2008. To make matters worse, people are paying more interest levels relative to their earnings than ever before. And regardless of the fact that house prices are currently at record highs in the United States, the mortgage rate is quickly approaching 7.5%. All of these factors combine to create an undoubtedly disastrous scenario for many of these new homeowners. Going back in time, we could see that housing prices fell by 35% during the last housing bubble. Fast forward to modern times, and we could see that housing prices are currently inflated by 23%. While some may argue that the housing market is less prone to a devastating crash this time around, the perception that every mortgage and loan is categorized as eligible loans makes this assumption false. If this economic downturn continues to spiral out of control, we'll see an increase in mortgage defaults. Such defaults will hit the housing market hard as more and more homeowners struggle to keep up with their mortgage bills. Given the statistics, it's clear that the housing market is at a crossroads. On the one hand, we have overestimated housing fees, which can essentially be a reason for a challenge. On the other hand, we face the inordinate likelihood that more and more homes are being held by homeowners who are unable to make their monthly payments. According to Goldman Sachs CEO Roger Ashworth, the high-end housing market is relatively stronger than it's been in the past. However, there's a primary issue here. Affordability is quickly becoming a major issue that cannot be overlooked. According to the most up-to-date stats, it looks like the 30-year fixed mortgage rate may even reach a whopping 8.5% by the time we reach the end of 2024. Yes, you heard that right. 8.5%. So if you're in the market for a loan or are considering refinancing, it's probably wise to pay close attention to these tendencies and regulate your plans accordingly. Recent statements by Jerome Powell, the U.S. attorney and financial banker, indicated that mortgage rates are currently at a high of 7.5% and are expected to remain that way. Homebuyers and traders should be aware of Powell's statements and keep in mind that mortgage rates could climb to an alarming 8% or more. Mortgage costs are rising more and more. This is usually caused by a monetary phenomenon known as crowding out. When the government borrows extra money and issues lots of debt, interest costs naturally rise to incentivize people to buy and invest. This expanded demand for loans eventually ends up crowding out personal investment, leading to more mortgage costs. This trend has been going on for the last 20 to 30 years. However, things have changed, and the 10-year Treasury yield is currently at an excellent 4.2%. If the authorities continue to issue debt with such fast charging, the number may be likely to increase. This trend is not limited to loan prices. Once interest costs start to rise, it'll affect different areas of the economy. So while a government loan might seem innocent in the short term, it could eventually lead to currency instability. Housing is a fundamental part of any economic system, and a downturn in the housing market can have a ripple effect across multiple sectors, including manufacturing, retail, and banking. Policymakers must address this issue and provide effective solutions to ensure that the financial system remains stable. In California, market demand is forcing sellers to rethink their pricing strategies. The current rock-bottom revenue activity is creating a ripple effect in the positive parts of the economy, causing several businesses to struggle to stay afloat. It's like the plight of real estate agents in America. The most recent figures show that the median household income, as the real estate agency reported, is 2.3%. It's becoming increasingly difficult for most real estate agencies to secure income and generate revenue, leading many to exit the business altogether. In fact, there's been an incredible 1% drop in the number of people actively working for estate agents over the course of 12 months. With lower incomes and higher levels of competition, listing property at an excessive price factor is not really a powerful approach now. Home buyers and investors, please remember that limited inventory does not always indicate that prices will remain unchanged. Instead, it's proof that even a little disturbance in the market should cause a dramatic increase in inventory, which in turn causes major issues. Aside from events like the housing market meltdown in 2008, it demonstrates how quickly things can go wrong. Low inventory means that the supply of homes is limited, which increases demand and will cause fees to rise sooner or later. However, this can be a double-edged sword. On one hand, this is wonderful for traders who can sell their houses for extra money. Now, it's not as notable for buyers who may struggle to find suitable homes in their price range. When inventory is low, any small hiccup in the marketplace can cause inventory to spike. For example, inventory can suddenly boom if more people decide to market their homes, or if there may be a whole new development that creates more housing options. This puts a significant burden on the market and can lead to a significant price drop. To avoid getting stuck in a crash, it's important to be aware of the potential dangers and keep a close eye on the market. Don't simply expect things to cross all the time due to the fact that the housing market can be unpredictable. Keep in mind that aside from activities like the 2008 economic disaster, it's been shown that things can take a turn for the worse in the blink of an eye. The National Association of Realtors reports that home buyers have many options. With an inventory of 2 to 3 million houses, there was a glut of 1 million properties on the market, a staggering 50% increase. Moreover, the drop in home prices, which has fallen by 25% nationally, is heavily influenced by this trend toward more affordable homes. The steepness of the fall increased to 40% in California and a staggering 60% in Nevada. Keep in mind that even if larger homes are available, if people can't afford to buy them, those homes will simply take up space on the market. So until the affordability issue is addressed head-on, the surge in housing stock may not turn things around as much as we'd hoped. Thanks for watching, and please make sure you subscribe if you enjoyed the video, and be sure to leave a comment below.